In 1964, Warren Buffett got cheated out of 12.5 cents. So he bought an entire company and fired the CEO. It felt good. It cost him $200 billion. The company Buffett bought out of spite became Berkshire Hathaway, one of the most valuable companies on earth. But Buffett calls it the dumbest stock he ever bought. How does a $200 billion mistake create a $100 billion fortune? It starts 2 years earlier. In 1962, Warren Buffett was running a successful investment partnership hunting for undervalued stocks. He found one, Berkshire Hathaway, a textile manufacturer in New England, $7.50 per share, below book value. Classic Ben Graham strategy: buy cheap, sell when it recovers. Buffett started accumulating shares. Textile manufacturing in the 1960s was dying. Cheap foreign labor, commodity products, razor-thin margins. No competitive advantage, but the numbers looked good on paper. This is a value trap. Low price-to-book ratio, trading below liquidation value. Looks cheap because it is cheap. The business has no moat, no pricing power, no sustainable edge. Ben Graham called these cigar butt stocks. One puff left, then it's trash. Take that puff and walk away. Buffett didn't walk away. Berkshire would occasionally buy back shares when it closed factories. Buffett would sell some back, then buy more when the price dropped. Trading it, not owning it. In 1964, Seabury Stanton, Berkshire's CEO, calls Buffett. They agree. Berkshire will tender for shares at $11.50. Handshake deal. The tender offer letter arrives days later. $11.37.5. 12.5 cents less. Most investors would take the profit and move on. Buffett didn't. When ego overrides analysis, the outcome is already determined. Perfect spreadsheets don't matter if anger is making the decision. Instead of selling, Buffett bought more shares, aggressively. Within a year, he controlled Berkshire Hathaway. First decision as majority owner? Fire Seabury Stanton. Except now Buffett owned a dying textile company he never wanted. The $200 billion mistake was just beginning. Buffett didn't liquidate. He tried to save it. For 20 years, Buffett poured money into the textile operations. New equipment, better management, cost-cutting. A competitive moat is a sustainable advantage competitors can't copy. Coca-Cola has brand power. Visa has network effects. Textiles? Anyone could make fabric. Buyers only cared about price. Buffett would later put it this way: when a manager with a reputation for brilliance meets up with a business with a reputation for bad economics, it's the reputation of the business that remains intact. Year after year, the division earned nothing. Meanwhile, the insurance companies Buffett bought on the side, National Indemnity in 1967, printed money. But he kept the textiles alive until 1985, 20 years of capital sitting dead. 1985, Buffett shuts down the textile operations. For 20 years, capital locked in textiles earning nothing, zero growth. But what if that money had gone into insurance from day one? In a 2010 CNBC interview, Buffett ran the calculation. If Berkshire had started as an insurance company instead of a textile mill, the company would be worth twice as much, roughly $200 billion. Why? Insurance companies collect premiums up front. Claims come later. That gap, called float, can be invested while it waits. Textiles consume cash. Insurance generates it. $200 billion in opportunity cost. It doesn't show up on brokerage statements, but it destroys wealth anyway. Something changed after Berkshire. The philosophy, the entire approach. Before, buy cheap, hope it recovers. Ben Graham's cigar butt strategy. Find stocks trading below liquidation value. Extract the remaining value. Move on. After, buy great businesses at fair prices. It's much better to buy something that's good at a fair price than something that is cheap at a bargain price. See's Candies. Buffett paid $25 million for a company earning just $4 million annually. On paper, overpriced. But See's had brand power, pricing power, a moat. That business has generated over $2 billion in profit since. Coca-Cola. Buffett invested $1 billion, expensive by traditional value metrics. But Coca-Cola had a global brand, distribution everywhere, customers who would pay a premium for red cans. That position grew to over $20 billion. Apple. Buffett started buying when value investors thought it was overpriced. But Apple had ecosystem lock-in, pricing power, customers who would queue for days to buy new products. Today, Berkshire's largest holding, worth over $100 billion. The pattern: great businesses, strong moats, fair prices. Then let compounding do the work for decades. The opposite of textiles, the opposite of cigar butts, the opposite of 12-cent revenge. 12.5 cents. That's what it costs to learn the difference between price and value. But Buffett kept the name. Berkshire Hathaway, the textile company he bought over 12.5 cents, became the vehicle for everything he learned. Every shareholder letter signed with the name of his biggest mistake. The man is worth over $100 billion today. He'll tell you it should have been twice that, all because of 12.5 cents.